morning, ladies and gentlemen. A very warm welcome to all of you back on Business Today Television. This is the beginning of a new calendar year 2026 after a painful 15-18 months that have lapsed as far as mid-cap and small-cap holders of equities are concerned. At the same time, we've seen glorious and phenomenal returns coming in the precious metal space. What does the crystal ball hold for 2026 as far as equity investors are concerned? How should you navigate the market ahead? And what are the possible shortcomings as well as problems that we might face? To discuss this and a lot more, we are now joined by Mr. Amit Goel, co-founder and chief global strategist at Pace 360. This is a very well-known PMS, having more than a 2-decade experience in managing not only its own money but also for long-term holders of equity and other risk assets. Namaste Amit ji, a very warm welcome. Happy New Year. What is your crystal ball telling you for 2026? More pain ahead or more gain ahead?
Firstly, thanks, Shell, for the warm welcome and wish you a very happy new year as well. And so I think my understanding is, Shell, that markets should look up before they go down more. I remain an optimist. I do think that there could be a rally post-budget, though the chances of a pre-budget rally have gone down significantly in the last few days, in my opinion, because the Indian markets have flattered to deceive yet again. So we did make a new all-time high just about 2-3 days back, and just when it looked that we are going to cruise along to 26,600, 26,700, we have yet again beaten a hasty retreat from those levels, and there has been a significant damage in the last just 2-3 days. So my sense is that chances of a pre-budget rally are somewhat diminished. But I remain an optimist that this budget is going to be, relatively speaking, a better budget than we've seen in recent times. The Indian governments have a very old reputation of acting when they are in a corner. And my assumption is that with FII exodus and with US-India trade deal not happening, they would want to do something to halt the FII exodus, to protect the rupee, and to improve the sentiment in the absence of a US-India trade deal. So probably pre-budget rally, I'm not expecting one significantly. But post-budget rally, I still think that there could be one.
This is a very interesting point, Amitji, that you raise on what the budget can do to bring back foreign money. Would you want to elaborate a bit more? About 2-3 years ago, the government had again tweaked taxes to make the FII trade a little more unattractive. Do you see a rollback there?
I think I do expect some measures for the economy. I do expect that some of the reforms which had taken a backseat in the last 2-3 years because everybody was in their comfort zone, and it almost seemed that we do not need any reforms anymore. But fact of the matter is that we do need them urgently this time around because of the because of what's happening in the world, what's happening between India and US, and what's happening in our economy and our markets. So my assumption is that we could see more of land, labor reforms, rural reforms. We are probably going to see a restructuring of the entire subsidy structure that we have in India. So I think they could make multiple noises, positive noises, and in the right direction to sort of alter the course, because the course is pretty painful. FIIs have not stopped selling the Indian market. in a very, very long time. And this has happened when the rest of the Asia and Asia Pacific and Europe and Japan and everybody has been celebrating and making higher and higher highs. If that has happened in that backdrop, we do expect, Shell, that post March, April, there is going to be sharp sell offs in the global markets because of how they are positioned and because of the various bubbles that have cropped up. So, my fear is that if the Indian government doesn't get its act together and they are not able to sort of alter the course, so we are going to be beaten when everybody is bullish, and when everybody turns pessimistic and markets, you are talking about a US recession, which I believe is going to happen in the next 12 months, then we are going to be beaten down again. So the only way that they can alter this painful course is that they make all the right noises about various reforms, about PSU banks, about PSU divestment, and strategic divestment, not just selling some stakes through OFSs or whatever. So that's the only reason why I am optimistic. Otherwise, frankly, my belief is that the best of the quarterly numbers in terms of GDP, they are probably behind us. We do not have great economic momentum coming into 2026. I think the GST cuts brought forward a lot of demand, which was supposed to have happened in the first 6 months of 26. It was brought forward to the Q4 of calendar year 2025. So there are a lot of things which are pain points, and the only way that this government, and they do realize the enormity of the situation. So I remain an optimist that this budget is going to be radically different and better from some of the previous ones.
Okay. In your opening comment, you made an intriguing remark, which you said that the markets may rise before they fall further. Would you want to elaborate? And in the same context, how do you see silver and gold even at these current super inflated levels?
Thank you so much, Shail, for asking that question. So, my assumption is that global markets are right now in a pretty good situation. S&P 500, which is of course the biggest index in the world and the mother market for the rest of the emerging and developed markets, that has done extremely well. It has been making higher highs practically now every day of the last few days. Nasdaq 100 is also very close to its all-time highs that it made in October. So my sense is that global markets are right now in a healthy situation. So if the Indian government delivers a good budget, then India could probably join this global celebrations over the next 2 months. But then eventually, Shell, I am not at all an optimist as far as the global economy, the global markets are concerned, because my assumption is that there could be a last hurrah rally between now and February, post the quarterly results, corporate results, and after that, I do feel that the rest of the year is going to be probably a downhill journey. So my best case scenario is that while the world is doing well and India is not participating, but we suddenly start participating because of a good budget, which I am hoping for, then markets kind of make their peak sometime between February and March. But after that, I am very pessimistic about the global markets and economy, because I do think that the economic momentum is waning, and US is probably headed for a recession sometime in 2026, probably the second half of 26. So this is the reason why I said that hopefully the markets will go up before they eventually go down. And lastly, you talked about gold and silver. So, Shell, my assumption is that gold and silver have come up a lot. Particularly, silver has outperformed gold massively. So the gold silver ratio, which was at 108 in April, has just made a low of 54. So just imagine gold silver ratio has gone down by 50%. I don't remember the last time when this ratio went down by 50% in such a short span of time. So my assumption is that while the overall commodity complex is doing very well, I'm not saying that they are just going to go down, they are just going to tank from these levels. I do believe that they are probably going to become sideways for the next 4 to 6 weeks. And then when the global stocks deliver their last hurrah rally between now and February, probably commodities are also going to do reasonably well. But when global equities go down in the in post February March, then my assumption is that gold and silver will also go down, because what we are looking at is a probability, very high probability of a deflationary bust happening in US and pretty much the world. The world is ready for an inflationary boom, while what I see in 2026 and 27 is a deflationary bust. So the markets are going to get a culture shock, because they are ready for one scenario, totally loaded and locked for one scenario, and the other scenario pans out. So there could be a shock nosedive in commodities in the second half of this year, which could take gold and silver down, but more of silver than gold. So I think gold is going to go down much less than silver and copper once it becomes clearer that we are probably headed for a global slowdown and a recession in US and in some other parts of the world, and also the fact that it's not going to be an inflationary boom, rather the probability of a deflationary bust will go higher and higher with passage of weeks and months post February.
Okay, that's a fairly dismal scenario, Amitji, you've painted, but and of course a very pessimistic one as well as far as equity investors are concerned. Now, how do we navigate this in terms of fresh allocation of money? Are you putting your money where your mouth is, in the sense, have you moved away from riskier assets? What is the game plan at your end?
Okay, fantastic, Shell. So what we did was that we did play a equity rally in December, and so we played for it. We got in, not to a substantial extent, but we went up to like let's say about 25 to 30% allocation in equities, and we have booked most of the profits there, and we are now down to less than 10% equity allocation. But we are very, very clear in our minds that before the budget, we are going to take it up back again. The only reason why we retreated was because the market was somehow flattering to deceive every single time. So we did not want to bet on a pre-budget rally or a New Year rally, so to say. But we do want to bet on a post-budget rally. So my sense is that now, very, very gradually, on every 125 points down on Nifty, we are probably going to continue to increase our equity allocation till about the end of this month, and we hope for a post-budget rally. And as far as new money is concerned, so apart from, of course, buying some of the best quality stocks, particularly large caps and some large cap ETFs, what we would want to do is we would want to gradually increase our allocation to very long-term government bonds. We are right now not sitting very heavily allocated to that asset, but very, very gradually between now and March, we are going to increase our allocation to long-term government bonds in India, which is like 30-year government bonds in India. And for our overseas investors, we'll increase allocation to 30-year government bonds in US. And I do see that there is going to be a massive rally in long-term government bonds once it becomes clearer that this could be a deflationary bust kind of a scenario. So that could be the breakout asset of the breakout asset class for the next 2 years. Till then, we'll continue to buy equities whenever we see a potential rally, but then we would also seize the opportunity and book profits wherever we get a chance. So, for me, equity allocation is not a long term proposition at this point. It is basically like hit and run. You buy when there is pessimism and you sell when there is optimism. And on the other hand, long term government bonds just keep on increasing your allocation between now and February, March, and that could be a double digit, a healthy double digit return, CAGR for the next 2 years.
Okay, so gentlemen prefer bonds, and from what I know of Mr. Goel, he's one of the very few gentlemen in the market, and therefore his preference for bonds is all the more interesting. So, how much of your portfolio, potential portfolio, in say the month of March or April, will be in long-term bonds in India?
I would say it's not going to be less than 50% shell, because while in corporate bonds we make about 10 to 11%. So the carry on a long-term bond in India is negative, because we make 10 to 11% in corporate bonds, while the carry, which means the long-term bond yield for a 30-year bond in India, is, as we speak, only about 7.33%. So there is a negative carry that we get of about 300 to 350 basis points in a long-term government bond compared to a short-term corporate bond. But we are still going to do that, Shell, because we are very confident that RBI would be taking down the interest rates even further, and more than what is discounted or is being talked about right now. And when inflation is not going to emerge pretty much in any part of the world, and in fact you could actually see negative inflation prints in some parts of the world, not necessarily in India, because our CPI basket is very different from most of the developed countries. But you could see a negative inflation print in US, UK, and Europe, and even Japan at some point. And if that were to happen, there is going to be a massive rally there. And I think that negative carry that we would incur in long term government bonds is going to be easily compensated by the fact that the capital gains on that could be something like a 15 to 18% capital gain over the next 1.5 to 2 years. So we are looking at about a CAGR return of 14 to 15% at the very minimum in 30-year government bonds in India, which is not a return which you are likely to get in equities or in commodities from this level, or in let's say corporate bonds. So I think that is going to be we are going to become heavier and heavier in long-term government bonds with every single passing month between now and March.
Okay, and that will also include a double A rated corporate paper.
Right now we have a lot of double A rated corporate paper in our portfolios. In fact, that is predominantly a very meaty part of the portfolio, which is delivering us 10.5%. But we are going to offload some of that to buy long term government bonds. And in between, whenever we get a chance to play equities, we would do that, because it is my belief that Indian markets are going to resist a lot on the way down, which is because of this domestic flow of money. So domestic flow of money is still pretty huge. The IPO, the IPO pipeline is still very robust. But if the sentiment takes a little turn for the worse, then what's going to happen is that the domestic money is going to keep coming in, while some of the IPOs are going to be postponed. So my sense is, Shell, that there is going to be a few months window, maybe a 6 month window, where Indian market would outperform pretty much every other market in the world, because of the fact that all this domestic your SIP and your lump sum money, which is going into IPOs and QIPs and rights issues, it is my belief that there would be a point for a few months where the balance is going to shift in favor of secondary market than the primary market, which would mean that the Indian markets are going to outperform most of the other world markets. We have significantly underperformed over the last 15 months. So it's not all gloom and doom, Shell. There are going to be points where there are going to be amazing opportunities to play an equity rally. It's just that we are choosing not to buy for the long term because we are very anxious about what could happen in the post AI bubble world, which would probably unfold over the next 2 years. So we do not want to take any long term bets when the probably the global economy and the US economy could be headed for a recession. Whenever a recession has happened in the world, then you know that India can go down significantly. But we will take opportunities from time to time to try and play these rallies and then augment the return that we make out of fixed income in the rest of the portfolio.
Right. On that deeply pessimistic note, as far as equities are concerned, Amit, let's pause for a while and let's hope that for your unit holders at Pace 360 PMS, this scenario pans out exactly as you've talked about, and for the rest of the world, we make supernormal money in 2026 as well. Thank you for your time, and again, we are looking forward to meet personally in 2026, and here's wishing you all the best as far as the current calendar is concerned, both professionally and personally.
Absolutely my pleasure and privilege. Thank you so much, Cher.
That, ladies and gentlemen, was Mr. Amit Goel, co-founder and chief investment strategist at Pace 360, a very well-known PMS based out of New Delhi. Continue watching Business Today Television. There's a lot that's happening as far as financial news is concerned. Amongst the main ones, 26,000 is now with the bears. Thank you for watching.